Income-driven repayment plans. Usually, the payment amount under an income-driven repayment plan is a percentage of your discretionary income. There are several factors such as income amount or family size that determine that percentage amount. You will need to gather documents on all of your taxable income. This will include federal income tax documents. If you are married, you will need documents of your spouse's taxable income. If you are receiving unemployment benefits, you will need to submit proof of unemployment income. If you did not file taxes or your income has changed since your most recent tax return, you will need alternate proof of taxable income such as pay stubs or a letter from your employer stating your gross pay. If you currently have no source of income, then you can self-certify as such on the application. You will also need a verified FSA ID. This is an account username and password that allows student and parents to identify themselves electronically to access U.S. Department of Education systems. You will need to provide personal information such as your email, phone number, and physical address. From this website you can apply online or download a paper request from and submit it to your loan servicer. Never pay an outside company for help with your student loans. Your loan servicer will help you for free. To find out who your loan servicer is, log into your account at studentaid.gov and scroll down to My Loan Servicers section on your account dashboard, or call the Federal Student Aid Information Center at 1-800-433-3243. Income-based repayment, YBR. Income-based repayment is type of income-driven repayment plan, IDR, that makes it possible for lower payments towards your student loan. It works by paying around 15% of your discretionary income above some threshold for 20 or 25 years, depending on if you took your loan before or after July 1, 2014, and you are eligible to get any remaining balance forgiven. Income-based repayment is one out of 4 IDR options that the Department of Education offers. This plan is available to undergraduate and graduate students. You have the flexibility to change plans if you wish to pay off the loan faster. You will have to reapply each year to report any changes in your taxable income. A major disadvantage to income-based repayment plans is that if you have had a low income for several years, the very low monthly payments may not be enough to cover the interest on the loan, which could cause the balance to go up. The balance will still be forgiven after 20 to 25 years, but the IRS considers the remaining balance forgiven to be taxable income. All Stafford and direct consolidated loans made under either the direct loan or the Federal Family Education Loan Program are eligible for IBR. Uninsured private loans, Parent Plus loans, loans that are in default, consolidation loans that covered Parent Plus loans, and Perkins loans are not eligible. To qualify for the IBR, you will need to establish financial hardship. Your monthly bill is determined by a formula that calculates your adjusted gross income, AGI, family size, and state of residence. The monthly amount that is determined by the formula above must be less than payments under the 10-year standard repayment plan to be eligible for an IBR. If your AGI is less than 150% of the federal government's established poverty line. Each year you will have to resubmit documentation showing your AGI and family size to your loan servicer to determine if any adjustments need to be made to your monthly payments. Pay-as-you-earn repayment, PAYE. This is a federal repayment program that caps your monthly federal student loan payment at 10% of your discretionary income. Pay-as-you-earn also limits capitalized interest to 10%. Pay-as-you-earn has the strictest requirements of any income-driven plan. To be eligible, you will need to have borrowed your first federal student loan after October 1, 2007, and you need to have borrowed a direct loan or a direct consolidation loan after October 1, 2011. The federal government requires you recertify your income and family size to qualify for the PAYE or other IDR plan each year. This means your monthly payments will likely change throughout your repayment period. The repayment period under PAYE is 20 years. After that, any remaining balance is forgiven. Keep in mind that the IRS considers any forgiven amount on your student loans to be taxable income. PAYE is a good option for married couples who file their taxes separately. PAYE is also a good option for anyone whose profession qualifies them for public service loan forgiveness. Revised. Pay-as-you-earn, REPAYE. This is a program that was started in 2015. This is a plan that caps payments at 10% of your discretionary income. Your loan will be forgiven after 20 for undergraduates or 25 years for people with graduate degrees. The difference between pay as you earn and the revised pay as you earn is that the repay is that far more people are eligible for this plan. Repay is available to all federal direct loan borrowers, except those with Parent Plus loans. If you have parent loans, you can only use income contingent repayment. One advantage of Repay is that it will pay the entire difference on subsidized loans and half the difference on unsubsidized loans for the first 3 years. It covers half the difference on both loan types after the 3-year period. Visit this website to learn more and apply. Income Contingent Repayment, ICR. The Income Contingent Repayment, ICR plan was built to make repaying student loans easier for those who wish to pursue jobs with a lower rate of pay. It works by factoring in the borrower's income, family size, and total amount borrowed to determine the monthly payment amount. The monthly payment amount is adjusted annually, based on changes in income and size of family. After 25 years of on-time payments, the remaining balance is forgiven. Income Contingent Repayment is currently available only through the U.S. Department of Education. ICR is not from banks or other private institutions making government-guaranteed loans through the Federal Family Education Loan (FFEL) program. However, if you have one or more FFEL loans, the Department of Education will allow you to consolidate your loan or loans into a federal direct consolidation loan so that you can elect income contingent repayment. You will need to visit studentaid.gov to submit an electronic application for consolidation. The interest rate is fixed for the lifetime of the loan and is not variable. It is based on a weighted average of the interest rates of the loans included in the program, rounded up to the nearest 1/8 of a percentage point. It may be advisable for students who wish to use this plan to switch to it just before their loans enter repayment, since the interest rate will then be the in-school rate, which is 3/5 of a percentage point lower. One good benefit of the ICR program is that although you must initially sign up for 25-year income contingent repayment, you are not locked into this payment plan. If your circumstances change and you wish to pay off your loan sooner, you may do so. Graduated repayment plan payments are lower at first and then increase, generally every 2 years, and are for an amount that will ensure your loans are paid off within 10 years, within 10 to 30 years for consolidation loans. Anyone with student loans is eligible for this plan. This is a good plan for those who already have a career lined up after graduation and will be expecting raises and promotions. Graduated payment amounts will never be less than that month's accumulated interest, unlike income-driven plans which can go down to $0 a month. You can visit the Student Aid website to get a general idea on your loan payments under the graduated repayment plan. It is important to keep in mind that you could end up paying more money than with the standard repayment plan. This is because the first low payments of the plan may not fully cover the interest rates. There is no loan forgiveness under the graduated plan. An extended repayment plan enables you to extend the time you have to pay back your student loan from 10 years up to 25 years. The monthly payments will be lower, but you will pay more interest over time. To qualify, you will need to have $30,000 in student loans or more. Almost all types of federal loans are eligible for the extended repayment plan, including PLUS and FL loans. Perkins loans do not qualify for extended repayment, but borrowers can consolidate their Perkins loans into a direct consolidation loan. This will allow your loans to be eligible for the extended repayment plan. You will need to contact your loan servicer to apply for this plan. You can find your loan servicer at studentaid.gov. You will need to log in or create an account. Then on your account dashboard, you can scroll down to the My Loan Servicers section. You can also call the Federal Student Aid Information Center, FSAIC, at 1-800-433-3243. You can also use the Student Aid Loan Simulator at studentaid.gov to get an early look at what plans you may be eligible for, and to receive a comparison of estimated monthly payment amounts for all federal student loan repayment plans.